Hello there. We're about to get into a massive topic for UK landlords, and we're doing it with some expert analysis from the team at My Tax Accountant. You've likely seen these so-called magic loopholes popping up online, all promising to wipe out your tax bill. But what if these easy fixes are actually a trap? Well, we're going to find out.
So let's just start with this one. Really critical question. Could a popular tax fix you've heard about online actually be the very thing that costs you your entire property portfolio? It sounds dramatic, I know, but believe me, the risk is very, very real.
To really get why so many landlords are desperate for a lifeline, you've got to understand the incredible pressure they're under. For many, it's a genuine tax nightmare. And to make this feel a bit more real, let's look at an example.
So, let's meet Sarah. She's worked incredibly hard for years to build up a small portfolio of 5 flats down in Croydon. You know, this is her business, her future, her pension plan. But a single change in the law recently just turned her whole world upside down.
And that leads us right to the heart of the problem, what's known as the Section 24 squeeze. This is the tax change that has pushed hardworking landlords like Sarah right to the edge, and it's what sends them online looking for, well, pretty desperate solutions.
So, what on earth is Section 24? Well, to put it really simply, if you're an individual landlord, you can't deduct your full mortgage interest as a business expense anymore. And here is the absolutely crucial part. You are now taxed on your total rental income, your turnover, not your actual profit. That changes everything.
Okay, just look at this slide. This really shows the damage. Look at Sarah's numbers before Section 24, a healthy $30,000 take-home profit. Now, look at the after column. Her income is the same, her mortgage costs are the same, but because she's taxed on her turnover, her tax bill nearly doubles. Her actual real profit gets slashed by more than half, down to just $14,000. Ouch. That's an extra £16,000 in tax every single year. For a lot of people, that's the difference between having a viable business and going bankrupt. So you can see why Sarah is desperate, right? She goes online and she finds what looks like the perfect answer. And this is where she stumbles right into the magic loophole trap. There are promoters all over the internet, many of them unregulated, pushing a structure that they claim can legally get you around Section 24 completely. And you know what they say, if it sounds too good to be true.
So here's the sales pitch, and it sounds deceptively simple. First, they say, put your properties into a trust. Then, make your new limited company the beneficiary. That company then makes these indemnity payments back to you, which you use for your mortgage. And here's the magic trick. The company claims full tax relief on the interest. Problem solved, right? Well, this is exactly where the trap is laid.
Okay, so this is where we bring in the expert analysis from My Tax Accountant, because they've taken a very, very close look at this structure. We are about to tear down this so-called solution piece by piece and show you the huge risks that the promoters just happen to forget to mention. The very first red flag is an absolute monster, and we don't have to guess what the banks think. UK Finance, that's the official body for all the mortgage lenders, has made it crystal clear. Transferring your property into a trust without telling your lender is almost certainly a breach of your mortgage contract.
And what's the consequence of that breach? Simple. The lender could call in the loan, demanding you repay the entire thing immediately. For a landlord like Sarah with multiple properties, that means total financial ruin. Stay with me because the next risk is just as terrifying.
So even if you somehow get past the mortgage problem, you're walking straight into 2 massive hidden tax bombs. First, there's capital gains tax. The promoters might tell you you're covered by incorporation relief, but the experts say that's highly unlikely to work. Why? Because from HMRC's point of view, you're not transferring a real business, you're just moving an asset around. Then there's stamp duty. You could suddenly be liable for the full whack on the property's market value, which is, well, it's a huge number.
So, what does that actually mean in pounds and pence? Well, for a typical landlord's portfolio, the combined, upfront, surprise bill for these 2 taxes could easily be over £450,000. Just let that sink in. That is a life-changing, business-destroying bill that the scheme promoters just forget to mention.
But the danger isn't just up front. Oh no. Even if you somehow manage to pay those insane initial tax bills, the scheme sets an ongoing trap that just keeps on working against you, year after year after year.
Remember those indemnity payments the company makes to you? Promoters might try to tell you they're not taxable, but HMRC's view is pretty clear. That money is fully taxable income in your name.
And here it is. The final devastating flaw in the whole thing. You now have this new taxable income from the indemnity payments, but because you don't technically own the properties anymore, you can't claim any relief on the mortgage interest you're still paying. And the result? The scheme that was designed to cut your tax bill actually makes it bigger. You end up in a worse position than when you started. It's a disaster.
And here is a crucial pro tip directly from the experts at My Tax Accountant. HMRC's guidance is very, very clear on this. If they believe you are involved in tax avoidance, you cannot rely on any concessions or so-called loopholes to get you out of trouble. They will take an extremely hard line.
Okay, so after all of that bad news, what are you actually supposed to do? Let's turn away from this road to ruin and have a look at the safe, expert-approved way forward. First, let's just quickly recap the huge dangers we've just covered. You have to avoid any scheme that involves breaching your mortgage terms, triggering those enormous upfront tax bills, accidentally making your tax burden worse, or relying on these flimsy loopholes that just will not stand up to any scrutiny from HMRC.
So, that brings us to the key question for every single landlord right now. With the 2025-26 tax year just around the corner, what is the right way to structure your property business?
And honestly, the answer is this. There is no magic bullet. There's no one-size-fits-all solution. Anyone who tries to sell you a simple product to solve this incredibly complex problem is someone you should not trust. Every landlord's finances are unique, and the only safe solution is professional tax advice that is tailored specifically to you and your portfolio.
Please don't risk your entire portfolio on some scheme you found on the internet. Get proper expert advice. The team at My Tax Accountant are specialists in this exact area. You can call them directly on 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk. And finally, just a quick disclaimer. The information in this breakdown is for general guidance. It's not a substitute for proper advice. Before you make any financial decisions, you absolutely must consult a qualified tax expert, like the team at My Tax Accountant. Thanks so much for watching, and make sure you subscribe for more essential updates like this one.